Financial system and its components. In this unit, we will learn about meaning and structure of financial system, composition of financial system and economic development, and overview of Indian financial system. The entire unit on financial system and its component is divided into 7 parts. Part 1 will deal with definition, function and objectives of financial system. Structure of financial system will be dealt in part 2, while part 3 will speak about composition of financial system. Part 4 will let us know about the different regulators of financial system. Flow of fund metrics is explained in part 5, while part 6 will speak about role of financial system and economic development. The chapter or the unit concludes with part 7, which will speak about an overview of Indian financial system. Part 1, titled as Introduction, we start looking at the definitions of financial system. Now, just to introduce the concept of financial system, a well-developed financial system is a prerequisite for economic development of a nation as it helps in creation of wealth by linking savings with productive investments. Financial system is an arrangement which allows for the exchange of funds between lenders, investors and borrowers. It consists of well-regulated, complex system of closely related markets, institutions and services which aim to provide an efficient and regular linkage between investors and depositors. According to Van Horn, financial system allocates savings efficiently in an economy to ultimate users either for investment in real assets or for consumption. While as per Prasanna Chandra, financial system consists of variety of institutions, markets and instruments related in a systematic manner and provides the principal means by which savings are transformed into instruments. The financial system is a set of financial institutions, financial markets and financial instruments, along with financial services. All these help in the formation of capital and meet the short-term and the long-term financial needs of households, corporate houses and that of government. Now let's have a look at different functions of financial system. Financial system is a mechanism which helps in increasing the pace of capital accumulation in an economy by mobilizing resources and ensuring its productive use. The different functions performed by financial system are as follows. First one, it helps in encouraging savings. It means financial system of a country basically encourages and promotes the saving habit among people by providing them with various options for saving their excess funds. The different financial avenues available in the financial market offer a reliable combination of income, safety and yield. A well-organized financial system with a well-regulated and a well-developed financial market and financial instrument helps to attract more savings as compared to underdeveloped financial structure. The size of savings helps to determine the level of domestic investment in a country. The second function is it helps in mobilization of funds. Now, a country adopts compulsory and voluntary methods of mobilizing resources required for capital accumulation. Contribution to Employee Provident Fund is one of the compulsory methods of savings adopted in India. In addition to this, different financial assets such as bank deposits, mutual funds, life insurance policies, bonds, equity shares, certificates of deposits, commercial papers, etc. are made available in the financial market. They help to mobilize the excess funds of household sector, corporate and public sector in the country. The third function is financial system assists in efficient allocation of funds. Provision of credit is another important function of financial system in the country. Financial system has to ensure that the resources mobilized are allocated to do their best possible use. The best possible use could be defined in terms of yield from investment and the purpose that will be served. The credit policy should ensure a balanced growth of all the sectors. Financial system helps to provide more credit to productive activities over non-productive or speculative purposes. Now let's try to study the different objectives of financial system. First one is to provide a payment system. As per reports published by RBI, currency is the most popular method of payment in India. The other instruments which facilitate the payment in India are check, bill of exchange, demand draft, banker's check, traveller's check, payment orders, money orders, credit cards, debit cards, etc. The second objective is to give time value to money. The concept of time value of money explains that present value of a given sum of money is higher compared to the future value. The core principle of finance suggests that any amount of money be better received sooner than later. This is because money has the substantial earning capacity. The different instruments available in financial market helps the investors add a time value to money. The rate of return earned on different investments adds up to the value of money. The third is to offer products and services to reduce financial risk or to compensate risk taking for desirable objectives. The risk of investing in stocks is reduced through an option of investing in mutual funds. The fourth objective is to collect and disperse information that allows the most efficient allocation of economic resources. The regulators of financial market like RBI, SEBI ensure that investors and borrowers are kept well informed about the performance of financial markets, financial institutions, and financial instruments by publishing different reports at different time periods. Certain websites which provide information regarding the performance of stock market in India are NSE Index, BSE Index, Economic Times Market, Money Control, etc. The last objective is to create and maintain financial markets that provide prices which indicates how well investments are performing, determines the subsequent allocation of resources, and to maintain economic stability in the market. Every financial institution offering different financial assets and services are expected to reveal the prices of their products and services to potential investors either through print or electronic media.